Good day, sir. I am Churel Abando Batallones, and today I will be discussing about inventory management. Inventory is one of the most expensive and most important assets for many companies, potentially accounting for as much as 50% of total invested capital. This emphasizes the substantial financial investment tied up in inventory and the importance of effective inventory management to maximize return on investment and minimize losses due to obsolescence, damage, or theft. Inventory encompasses a wide range of assets, from raw materials and work in progress goods to finished products held for sale. The key is that these resources are held in storage to meet anticipated demand either immediately or at a later date. These are the classes of inventories. First, raw materials inventory. This consists of the basic materials purchased from other companies to be used in the production of goods or products. These are the fundamental inputs to the manufacturing process. 2. Work in process inventory. This category includes partially finished goods that require additional work before becoming wholly completed products. These are items currently undergoing production. 3. Finished goods inventory. This includes completely manufactured goods that are not yet sold. These are ready for sale and distribution to customers. 4. Supplies. These are materials regularly used by the company in its operations but are not part of the finished goods sold. Examples might include office stationery, cleaning supplies, or maintenance materials. They support the business's functioning but are not directly incorporated into the products sold. These are the importance of inventory management. First is decoupling function. Inventory acts as a buffer separating different stages of the manufacturing process. This prevents disruptions in one area from immediately impacting other parts of the production line. If one stage experiences a delay, the inventory acts as a cushion, allowing other stages to continue operating until the bottleneck is resolved. 2. Storing resources. Inventory allows for the storage of raw materials either independently or as part of work in progress or finished goods inventory. This ensures materials are readily available when needed for production, avoiding production delays caused by material shortages. Irregular supply and demand. When supply or demand for an item fluctuates, maintaining a certain amount of inventory on hand is crucial to meet customer needs during periods of high demand and avoid lost sales. Let's proceed to ways in managing inventories. First, monitor inventory ratios. Regularly track inventory ratios. A downward trend signals potential problems like deterioration or obsolescence requiring attention. 2. Avoid overinvestment in volatile items. Do not overstock items with fluctuating prices. Maintain an optimal inventory level to minimize risk and cost. 3. Hedge against foreign exchange risk. If importing goods, implement strategies to mitigate potential losses from currency fluctuations. This could involve hedging techniques to lock in exchange rates. 4. Examine spoilage. High spoilage rates often indicate issues with material quality or storage conditions. Regularly assessing spoilage helps pinpoint and address these problems. 5. Analyze inventory relative to sales. A large amount of ending inventory with high purchasing but low sales suggests overstocking, indicating a need for better demand forecasting and purchasing strategies. 6. Eliminate slow-moving inventory. This reduces storage costs and improves cash flow by freeing up capital tied up in unsold items. Strategies to address this might include sales promotions or re-evaluating the product's marketability. 7. Watch out for inventory risk. Be aware of the inherent risk associated with certain types of inventory, particularly technology products, fashion items, and perishable goods. Minimize this risk through careful planning and purchasing. 8. Forecast material prices. Predicting future material prices is crucial. If prices are expected to rise, purchasing additional materials in advance can mitigate the impact of increased costs on the businesses. Let's proceed to types of inventory cost. Order cost. It is also known as purchase cost or setup cost. This represents the fixed cost incurred each time an item is ordered. The included formula and graph illustrate that the total ordering cost is the product of the number of orders and the ordering cost per order. Maintaining a high volume of inventory reduces the number of orders needed, resulting in lower total ordering cost. Conversely, low inventory levels lead to more frequent orders and higher total ordering cost. Trade-off between carrying cost and ordering cost. Ordering large quantities reduces the number of orders placed, lowering order cost. However, it increases amount of inventory held, leading to higher carrying cost. The graph illustrates this inverse relationship as order size increases. Carrying costs rise while ordering costs fall. The optimal order quantity is the point where the total of both costs is minimized. Effective inventory management involves finding this balance to minimize total inventory cost. Optimum number of orders as the ideal frequency of placing orders to minimize total inventory cost. The formula provided, optimum number of orders is equal to usage per period divided by EOQ, calculates this number. The example shows a calculation taking into account both carrying cost and ordering cost to arrive at a total inventory cost. The goal is to find the order frequency that balances this cost for maximum efficiency. Just-in-time or JIT inventory. This is a production strategy where materials are received only as needed for production, minimizing inventory holding cost. It often works in conjunction with total quality control programs to ensure the quality of incoming materials. Lean production. This approach emphasizes efficiency and waste reduction. It requires close collaboration with suppliers to ensure high-quality materials and efficient design for manufacture or DFM processes. Close cooperation with vendors is critical for lean production success. Let's move on to short-term financing. Short-term financing refers to funding obtained for a short period, typically less than 1 year. It is also known as working capital financing and is used to cover immediate business needs and operational expenses. Unlike long-term financing, which is used for major investment, short-term financing addresses temporary cash flow gaps and seasonal demands. These are the advantages of short-term financing. First, it is easier to arrange. Short-term financing is generally quicker and simpler to secure than long-term financing. This is primarily because the financial institution, like a bank, faces less risk. The shorter repayment period means less time for unforeseen circumstances like economic downturns or business failures to impact the loan's repayment. This reduced risk translates to a less rigorous approval process requiring less extensive financial documentation and analysis. Next, it is less expensive. The interest rates on short-term financing are usually lower compared to long-term financing. Again, this is due to the reduced risk for the lender. The shorter loan term minimizes the lender's exposure to potential interest rate fluctuations or changes in the borrower's financial health. Lower risk equals lower interest charges for the borrower. Lastly is it affords the borrower more flexibility. Short-term financing provides borrowers with greater flexibility, particularly in times of fluctuating interest rate. Borrowers can potentially take advantage of declining interest rates by obtaining funds in smaller amounts like piecemeal as needed rather than securing a large loan upfront at a potentially higher rate. This allows for strategic borrowing based on current market conditions. This flexibility can also be useful for businesses with unpredictable cash flow needs. They can borrow only what's needed when it's needed instead of needing to borrow a larger amount to cover potential future needs. Let's proceed to disadvantages of short-term financing. First, interest rate fluctuates more often. Unlike long-term loans, where the interest rate is usually fixed for a long period, short-term loan interest rates are subject to more frequent changes. This is because short-term interest rates are generally more sensitive to overall market conditions and central bank policies. If interest rates rise during the loan term, the borrower will face a higher interest expense than originally anticipated, potentially impacting their cash flow. Next, refinancing is frequently needed. Because short-term loans have a short maturity period, typically less than a year, they often require refinancing to extend the loan period. This process involves renewing the loan agreement, which usually requires updated financial documentation and potentially a review of the borrower's credit worthiness. The administrative burden and potential delays associated with refinancing can be a significant drawback. Lastly is delinquent payment may be detrimental to the credit rating. Missed or late payments on short-term loans can have a significant negative impact on the borrower's credit rating. This is particularly problematic if the borrower is already experiencing liquidity problems because a damaged credit rating will make it even more difficult to secure future financing, exacerbating their financial difficulties. The short repayment period means that any missed payment has a more immediate and noticeable effect on the credit score. These are the sources of short-term financing. Trade credit. This is the most common form of short-term financing. It involves delaying payment to suppliers for goods or services purchased. Suppliers often offer a grace period like 30, 60, or 90 days before payment is due. This allows businesses to use the purchased goods to generate revenue before needing to pay the supplier. Stretching of payables. This is similar to trade credit but involves intentionally delaying payment beyond the agreed upon terms. While this can provide short-term cash flow relief, it can damage relationships with suppliers and potentially lead to penalties or late payment fees. It is generally not a sustainable long-term strategy. Accruals. These are expenses that have been incurred but not yet paid. Examples include wages payable, taxes payable, and interest payable. This represent a short-term source of financing because the business has use of of these funds until they are paid. Short-term bank loans. Short-term loans are provided by banks for a specific period, typically less than 1 year. Ay, ano ba ni? Ay. Short-term bank loans. Short-term loans are provided by banks for a specific period, typically less than 1 year. These loans usually require collateral or a strong credit history. They can be used to cover a variety of short-term expenses. Commercial papers. These are short-term, unsecured promissory notes issued by large corporations to raise short-term capital. They are generally considered a low-risk investment for buyers. Receivable financing. This involves using accounts receivable, outstanding invoices, as collateral to obtain a loan. The lender advances or a percentage of the value of the receivables and the borrower pays the loan as the receivable is collected. Lastly is inventory financing. This involves using inventory as collateral to secure a loan. The lender provides financing based on the value of the inventory, and the inventory serves as security for the loan. Factoring of accounts receivable. This involves the outright sales of accounts receivable or invoices to a bank or financing company called a factor in exchange for immediate cash. Inventory financing. This is a financing option specifically designed for companies that lack collateral to secure a loan. It uses the company's inventory as collateral. That's all, sir. Thank you. That's all, sir. Thank you. Bankers' acceptances. These are short-term debt instruments that are accepted and guaranteed by a bank. They are often used in international trade transactions and offer a relatively low-risk financing option. Commercial finance company loans. Commercial finance companies specialize in providing short-term financing to businesses. They often cater to businesses that may have difficulty obtaining financing from traditional banks. Commercial papers. These are short-term, unsecured promissory notes issued by large corporations to raise short-term capital.